Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Camporeale of JPMorgan saying the pace of easing will be much slower going forward. The labour market weakness from the summer was misread. As long as the Fed can continue to carefully bring rates down over the next year, our thesis of a soft landing and a broadening out of equity returns will be supported. Phil joins us now for more. Phil, good morning to you. It's good to see you.
Good morning. Good to see you.
Haven't seen you since the election, and last time we spoke, you were super bullish. Are you even more bullish now?
Yeah, so before the election, we were saying it's going to be really hard to fade U.S. exceptionalism. We just didn't know if it was going to be U.S. exceptionalism in lowercase with a period, or U.S. exceptionalism in like big bold letters with an exclamation point. And I think we got the exclamation point. Okay, so we're still bullish. We're still overweight by 10%. We were 10% overweight equity the day before the election. We're 10% overweight today. And the two words that I took from Chairman Powell's quote yesterday, you know, the whole world focused on hurry to cut rates. Mine was strength and economy, right? And that's the fundamental story, particularly with the U.S. consumer, John. I've been on this program talking about the U.S. consumer a lot. They're the most important consumer to get right. And October gave us such a big signal. It was the largest 1 month gain in consumer confidence since the reopening of 21, the biggest contribution to consumption in the third quarter since the beginning of 2023. And the BEA found about $1 trillion when they revised the savings rate higher. So the U.S. consumer to us looks strong. The bottom line for us, 15% probability of recession over the next 12 months. 15 is as low as you could possibly get. And, you know, for us, because no such thing is zero probability. And at the end of the day, you want to make a big deal about rates. The average 10-year rate this year has been 4.2. We're at 4.4, and the S&P has squeaked out 25% gain. Okay, so it's a pretty supportive environment for us still because of the fundamental signal.
That's the story. It's a beautiful story.
Thank you.
Got to talk about the price of the story. Let's talk about the price of the story. Credit spreads are really tight. Forward multiples are pretty elevated. We are seeing the data come in pretty strong, but that's well priced. We've taken out a lot of rate cuts already for the Federal Reserve. Just how well priced is this story? Yeah,
good question. So when we were here pretty much up through the summer, we were talking about the cap-weighted S&P. We were talking about mega cap tech. That's still part of the story, John. But our two latest trades have not been that. One has been equal weight. Okay, so get a little bit of every stock. But I think one of the ones that's really coming up is mid-cap now. So mid-cap for us makes sense for three reasons. One, valuation, 17 times versus the 22 times that you're quoting on the S&P. We have about a 13% earnings growth for next year, which looks pretty good. And you just don't need as many rate cuts. Like, it's got a little bit less sensitivity than small cap. I mean, yes, we could have jumped into the deep end of the pool and bought small cap, but we're getting there through mid-cap. So it's a broadening out of U.S. exceptionalism. Don't bail on the mega cap, but we're diversifying that with some other things. And then high yield at the end of the day, I mean, how tight could it go? It's like the two-faced high yield market. You have this like 5th percentile spread, right? And then you look at it again and you're like, oh my goodness, it's 50th percentile all in yield. And a lot of our clients just want the yield, including us. We want this boring, less glamorous alpha trade of out-yielding our index in a world where the fundamental story continues to support high yield.
Well, usually one trade that works pretty well is the more credit spreads tighten, the better risk assets as a whole do. If there's just less room now for credit spreads to tighten, does that put any ceiling on risk overall, or just the correlation's all out of whack considering how tight things have gotten?
Yeah, so that's a good point. I think it's a whole story, Danny, of like macro volatility coming down. I can make, you know, this might not get the best ratings, but I can make the case that uncertainty is actually less now, not more. You know, post-election, we know who's there. We know also that if history is a guide, a lot of companies tend to put money to work no matter who they voted for after an election, which I think can support the broadening out rally that I'm talking about. We're not expecting high yield to tighten. Maybe it should trade through treasuries because one of those has 100% debt to GDP and one of them doesn't. But that's not going to happen. I think at the end of the day, the high yield story is in the background. Janet Yellen said it's like watching paint dry. That's what she wanted monetary policy to be. That's what we want the high yield carry to be in our portfolio.
Okay, so the rally broadens out.
Yeah.
But does leadership change?
Yeah, I think that's the key. I think leadership does change. I think it changes to things that are more pro-cyclical. So remember what I said, U.S. exceptionalism, bold letters, exclamation point. That just doesn't mean mega cap. I think it means that you have the financials and industrials taking part, and that's how we're positioned for next year. I mean, we have our soft landing definition is about 2 to 2.5% growth, 2 to 2.5% inflation. If you just Google nominal growth of 5 with earnings, you get a lot of leadership in that environment. And I think that's pretty supportive. And one of the things I really don't want to see is a 50 basis point rate cut. I don't want to see that, and I don't want to see a 2% CPI rate, because I think if that's happening, we're wrong on the fundamental story and the growth story.
Last week, immediately after that election, we began to price what looked like a really positive growth shock, really loud. And Mohamed El-Erian came on the program and he said that sound is the sucking sound of capital being taken away from the rest of the world into the United States. You keep saying U.S. exceptionalism. Where does it leave Europe? Where does it leave China? Where does it leave Japan? Where does it leave EM?
Okay, you want me to answer all those?
Please.
So I think if I were going pecking order here, I think it would go to the U.S. So out of our 10% overweight, 80% of that is in the U.S. And then the other piece, John, we have a small piece in emerging markets. So, in 2016, if you listen to anything President Trump said on the campaign trail, you wouldn't have touched EM with a 10-foot pole. In 2017, EM was up 38% because of the coordinated global growth theme. So the fundamentals kind of went out there. I'm not saying that's going to happen this time, but we do have an environment where at least China is acknowledging their property market. It's fallen flat again, but it is somewhere where we just want to be careful of being too underweight. And then the Japan story, it just gets a little complicated with the Bank of Japan normalizing rates and what that does to dollar yen. I think it makes it a little bit easier if the Fed's not going as much, that the Bank of Japan can start to normalize, and it won't be like that early August trade. So in terms of pecking order, I think it would go U.S., EM, Japan, and then Europe would be a funding source at this point. They're growing at 1, we're growing at 3, European Central Bank is cutting, and we only have 75 basis points of easing priced out to the end of next year. Okay, and that's kind of a weaker euro story, which isn't great for investors here in the U.S.
Phil, you sound so bullish. What's the risk of Donald Trump putting on tariffs that are blanket, 60% on Chinese imports and 10% from everywhere else?
Yeah, so Emery, I go back to 2019. President Trump lost the majority in the midterm elections of 2018, and growth that year was 3, and inflation was 2, and the Fed was cutting. And I just don't know if these tariffs are going to lead to the inflation. I think it could be more of a growth side. But policy error, Anne-Marie, probably is our biggest risk, whether it be from the administration or whether it be from the Federal Reserve. And I think the Federal Reserve kind of got the message. They thought the unemployment rate was going to be 4.4 at the end of this year. It's 4.1. But to your point, policy error is probably the biggest risk. It's not the left tail. It's not recession. It's policy error from either the administration or the Fed.
Then what would be the catalyst for that 15% recession call possibility you have, which I know is low, but what would be the catalyst?
It would be business caution and then kind of layoffs. So we're watching initial jobless claims really closely. So do claims or the labor market show signs of cracking? There was like this hoodwink earlier this year that the Fed fell for, and Claudia Sahm was like, no, it's not happening. So I think at the end of the day, it would have to come from the labor market, Anne-Marie, and then the uncertainty, as you said, on tariffs, on growth, and then that's the business caution, and it kind of goes the other way. Not priced in right now.
Claudia turned out to be right, at least so far. Jobless claims yesterday, 217. Phil, it's wonderful to catch up with you.
Thank you.
To get an update on your thoughts. Thank you, sir. Phil Camporeale there of JPMorgan. Turning to Nvidia, Frank Lee of HSBC raising his price target on the chip maker to a joint street high of 200, writing, "We have pondered this amazing growth trajectory, and not only do we see no signs of a slowdown, we expect further upside in 2026 data center momentum, which in our view is still not fully priced in by the market." Frank joins us now for more. Frank, welcome to the program, sir. I just want your opinion on what's behind that train and why it doesn't slow down anytime soon.
Sure. I think it's, every couple of months, everyone, I think, goes through the same question of, can Nvidia continue on this amazing growth trajectory? It is now approaching kind of uncharted territory in terms of the market cap of the company. But what we continue to see is that the overall spending on hyperscaler CapEx continues to go up. Since May, we've noticed there's been a 20% upward revision in the overall street consensus view for the four major hyperscalers. If we look at that in terms of potential server capex next year for AI, we think that's going to be more than enough to cover NVIDIA's growth, at least for the going into next year.
Frank, we've got to talk about the source of that demand and how strong you believe their biggest customers are, and whether those customers you think have demonstrated and done a good enough job of justifying their investment over the last few years. Do you think they're doing that?
Yeah, no, I think that's a great question. I mean, the question everyone comes back to is, this investment that's going on, what's the return, what's the monetization? It is a fair question, and it's not a question that I think has been fully answered. But I think from what we can see is that the spending continues, and into 2025, there's no sign of any slowdown. And we've also seen, I think, collaboration from what we're seeing on the supply chain in Asia. We continue to see many companies out here that continue to see upward revisions from the NVIDIA supply chain. So it seems to be going hand in hand in terms of the investments we're seeing from the hyperscalers as well as we're seeing in the supply chain.
But just given that, Frank, I mean, is there not some form of concentration risk for Nvidia when Microsoft makes up nearly 20% of your revenue, Meta another 10? Aren't these real risks if any of them pull back even slightly?
That's a good question. I think, the concentration risk is still there, but it is diversifying. So as an example is, if you look at the enterprise, which is the non-hyperscalers, right, they're becoming a bigger and bigger part of this market. If you look at 18 months ago, I would say hyperscaler spending is probably 80% of the market. Now it's probably looking to be about 60% of the market. So while it is still a very high concentration, that risk is coming down. You're seeing further expansion into the corporate world in terms of spending there. So that's why you see companies like Dell, which are traditionally not leveraged to the hyperscaler growth. They're seeing very strong growth trajectory in AI as well.
So Frank, we're going to hear from the company in about 5 days' time on the 20th for their earnings. Options markets pricing in something like an 8% move either way. What sort of fireworks are you expecting on the day?
Yeah, I mean, I think, they will have a beat on their revenues. We expect they'll beat on the current quarter as well as give a better guide relative to consensus. That being said, though, the share prices have had a very good run into the earnings. And so whether that's going to be enough to really, give the market an extra boost, I think it still remains to be seen. But I think we're taking the view that, it's not just the next 2 quarters, but if you look at all of next year, we do feel that confident that there'll still be further upside in terms of the market expectations.
I wanted to ask you about what was going on with the DOJ. They sent subpoenas to Nvidia in September. For Nvidia, do you see a change of an environment with the election and potentially what policy regulation could look like for the company next year?
I think it's there's going to be a lot more probably uncertainty and noise now, but I think it doesn't change the fundamentals. The fundamentals is that the company's dominant position in AI is unchanged. We don't see any immediate competition. In fact, I think the hyperscalers themselves, who have every interest to try to develop their own chip to reduce their dependency on Nvidia, is not able to do that. In fact, I think some of their own chips they're designing, the momentum is actually slower next year. So it shows you that in terms of being able to compete, we still don't see anybody narrowing that gap yet. So I think the fundamental outlook's not going to be changed. There will be probably a lot more, I think, just headlines. But I think if you just look at the overall earnings growth and expectations, I think that remains largely unchanged.
What about outside the United States? Geopolitical concerns, especially when it comes to the fact that the chips are made in Taiwan, and we have a president-elect who's very hawkish, and his rhetoric is very hot when it comes to China.
Yeah, so I think, if you think about the China exposure for NVIDIA as a whole, it is coming down. At its peak, China was probably more than 20% of its revenues. It's now at a point where I think China itself is only going to account probably for somewhere around 10% of its revenue. So it's come down in terms of that as being an end market. As far as I think where the chips are made, I think that's not something that's going to change in the near term. The TSMC is building factories in the U.S., but it's going to take some time before they're able to be able to increase production there. So I think, reality is that while there's going to be some rhetoric around it, it doesn't change the fact that the manufacturing base is going to still stay in Taiwan given the dominance of TSMC, and that's not something that's going to change in probably anytime soon.
Frank, when it comes to the politics, for the CHIPS Act, out of $123 million, a total of $33 billion out of a total of $33 billion for the CHIPS Act, only $123 million has been announced. As we head into the twilight of the Biden administration, what sort of pushes do you expect them to make with the CHIPS Act? Can anything else get done?
Yeah, there's not going to be that much time left, and I think if you think about the CHIPS Act, there hasn't been that much money, as you said, as you pointed out, actually been given out. I think where the majority of the CHIPS Act, associated with the CHIPS Act, that's helped companies like Intel has been the tax credit. So they've been able to get, I think, the advantages on tax credit, but they haven't really gotten enough subsidies. In fact, no one's really has. So I think if you think about, I don't think it changes the calculus of things. I think at the end of the day, the onshoring trend is going to continue. It will continue to take time, but I don't think it really changes, the trajectory where there will be people will be looking to change their investment cycle. I think the longer term geopolitical events is here to stay, and I think companies are going to build regardless of how much funding they get.
Hey Frank, good to catch up. Appreciate it. Going into Nvidia earnings a week away. Frank Lee there of HSBC. So here's the latest this morning. Retailers reporting over the next week facing down the prospect of higher tariffs and a shortened holiday shopping period. Greg Melich of Evercore ISI remaining optimistic. Election clarity is hopefully a cheap form of stimulus. Trump tariffs and tax cuts should prove neutral to positive. Greg joins us now for more. Greg, before we get into holiday shopping and the consumption boom we might see over the next few months, can we just talk about how these retailers might manage inventory between now and inauguration of President-elect Donald Trump, whether we're going to see these massive imports come from China, whether that's already started to get ahead of those tariffs?
Yeah, I don't think there's any surge ahead of tariffs. For a lot of large retailers and even smaller ones, we went through this a few years ago, so they have a playbook as to what they're going to need to do ahead of those sort of shifts. And I guess what I would say is right now they're still dealing with remembering very recently the problems we had with the ports on the West Coast a few years ago and getting that inventory in time. So I think they're being cautious in terms of how much inventory they bring in early or quick ahead of some theoretical tariff change, which will be very basically country and product specific probably at the end of the day.
Greg, how much more resilient are those supply chains now? Have they diverted traffic away from China? Is it going through somewhere else, away from Mexico? What are the big changes that you can identify?
It's a great question. I think from if we go back to pre the tariffs, so it's like back 2017, 2018, it looks like what retailers are bringing in from China is down probably 25 to 30%. A lot of that hasn't moved back to the U.S. It's moved to Mexico. It's moved to Vietnam. It's moved to India. So there's been a broadening out of the global supply chain, and this will probably further accelerate that trend to go to where products can come in with higher quality at a lower cost. And there might even be some reshoring as well, or nearshoring that has been part of the trend, but not the major movement.
Greg, the date I want to know about, not Trump's inauguration, but January 15th. That's when the deadline for the Longshoremen Association expires, and they need to come up with a new deal. What is the risk that we have a repeat or something worse than we did in months prior, especially with a new administration that's, for all accounts, less friendly to unions?
Look, that's a great question, and frankly, I'm glad you brought it up, because as we talk to retailers and vendors, we're finding that date hopefully it'll get sorted, but that's still a very real and relevant date without any theoretical tariff changes in the future. So making sure that we have the products that we need if there is a disruption and if a final deal isn't signed by then is important. So look, there's a lot of moving pieces, and that's why I would say even though we think the consumer's in a better spot and will be slightly better into next year, it's certainly not a V-shaped recovery by any stretch of the imagination.
Let's talk about that better spot for the short term. What do you anticipate the holiday season demand to look like?
We're looking for retail sales to settle out at this 3 to 3.5% nominal growth rate. We'll get October numbers later today, which we think will be in that range. And the things we're watching, it's really the categories that we think are starting to have rolling recoveries. We think home improvement is one that after 14 quarters of negative traffic at Home Depot and Lowe's, that's a category that will start to turn positive next year. Maybe not by first quarter, but certainly later in the year, because our home improvement lead indicator has had a pretty sharp acceleration in the last 6 months.
Ahead of the holiday period, though, I'm looking at names like Target, Walmart, Amazon, when people are going to potentially go and buy some of these big ticket Christmas items. Who do you think is going to fare the best?
You know, I think it's the trend that we've seen all this year continues. The consumer is willing to spend, but they're very cautious and value focused, and they want to see newness. And what we've seen from that is Amazon, Walmart, and Costco so far have combined for 70% of retail dollar growth this year. So retail sales are up a little over 3%. If you X out those three retailers, retail sales are growing 1%. So I think for a lot of the other ones, it's really catching the right trend, having the right product, having the newness, making sure you lean into value. That's how some of those other retailers could hold through this. But I think those three, Amazon, Costco, and Walmart, are in a very good spot.
Apparently there's 5 fewer holiday shopping days when it comes to this season. Do you think that's going to affect the outlook?
Yes. I have the gray hair to remember when this had a bigger impact. I think that e-commerce growth to now 22-23% of U.S. retail sales has changed it, and maybe it's a little less of an impact because there's more flexibility in how people shop and acquire goods for holiday. But at the end of the day, I would say it might be 50 bips of pressure, all else equal, just because there's fewer days between Thanksgiving and Christmas to get stuff done.
They're trying to add days. Trust me, Greg. We went to Bloomingdale's day after Halloween. Straight away, Christmas music. Didn't stop, did they?
Jingle bells. It was ridiculous.
Greg, thank you, sir.
We had to get ready for it. Yeah.
Appreciate your time. Let's catch up again soon. Greg Melich there of Evercore.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.